Happy Friday, everybody. Welcome into Mining Stock Daily in this long-form episode to end our week. We're coming into this thing all cylinders firing away because there's a lot to cover here, talking about the disconnect between the high-flying equity market and commodity prices and what it all means. So I brought in some two really good friends of mine, Zach Abraham and Chase Taylor of Bulwark Capital. We're diving into the mispricing of equities on the back of higher oil prices, higher yields that we've seen throughout the week. And it's not just higher oil, like we saw inflation pick up in the PPI. It's just quite fascinating. But yet the stock market making all-time highs almost each and every day. So we tackle that with Chase and Zach as well. Special thank you to Visa Silver, Revival Gold, Equinox Gold, and Integra Resources for their continued support of the podcast. Lots to cover here. We go real deep on a couple of other important topics as well, philosophical, I might add. Special thanks to them both for their time. And special thank you to you for tuning in. Let's join my conversation with Zach and Chase. All right, we've got a lot to cover here, and I got to admit, I am somewhat triggered for this one. I'm really up for this conversation, not only because we got a lot to talk about with what's happening in the markets for natural resources, mining, metals, oil, but we're also going to talk about the big markets here continuing to push to all-time highs. I am so thrilled to welcome in Zach Abraham, Principal and Chief Investment Officer from Bulwark Capital, and also Chase Taylor, analyst over at the same firm. They also host the Know Your Own Risk podcast as well. Two lovely gentlemen, and my God, guys, what seriously the fuck is going on? Because nobody is paying it. Like, the Strait of Hormuz has been closed for more than 2 months, and nobody cares. Nobody cares.
Chase, you go first.
Yeah, well, I mean, I'm just as triggered. It's been I even asked on Twitter, like it's been probably a month ago at this point, if Crazy Pills Capital was taken as a hedge fund name yet, because it has felt like full blown.
I'm gonna go
Crazy
buy that
Pills.
domain right now. But buy the domain.
I don't know how else to explain some of the some of the price action in the recent weeks and stuff. I mean, obviously, a lot of it is. The price action has driven the narrative, and the price action has been bad because we've all been Axios 4 times in oil. So I think that's a lot of it. But honestly, what bothers me more is the fact that everyone acts like the only thing that comes out of the Strait is oil, as if there wasn't also gas and some people know fertilizer. I get that, but like the petrochemicals, like there's so much stuff, and that stuff is in everything, which means this is an inflationary crisis. Like staring us in the face, and I guarantee, like we had a really hot PPI this morning, like smoldering hot, and I guarantee most of the macro type world was looking at it, scratching their head, like that's weird. That's probably just a 1 month thing, right? Like so, yeah. No, I'm with you.
Maybe let's talk about the inflation data, because CPI came out earlier this week. It was a little hot, but it wasn't like fearful hot. The producers price index was screaming hot. It was 1.4% month over month, 6% year over year, obviously driven by rising energy prices. That is insane. And still the market's at all-time high. It just doesn't care because people are able to brush this aside because nothing bad ever happens, right?
Yeah.
Let them eat chips.
Yeah. I mean, well, it's funny because one of the things that we've been talking about this last week is, and I don't want to speak for Chase, but the number I threw out there is I think that if you've got CPI by the end of this year trading with a 5 or 6 handle on it, I think that's a win. Meaning and it doesn't surprise me at all that you're seeing it in the PPI, because the real inflation, like we said this yesterday on our show. I said, look, inflation's a fait accompli. Forget about it. Book it. It's coming. And it doesn't surprise me that we're seeing a warm reading in CPI and then hot on PPI, because it's just starting to feed through. So when you're looking at things with clear eyes and you're doing, like Chase said, 5th grade math, 5th grade arithmetic, you can see that, oh yeah, prices are going to go higher, right? Like it's like right now,
Right.
based on what's happened right now. And it's really, it's like you said, it's really wild. The way that I'm internalizing it is, look, the market's mispriced. Why do I feel confident saying that? Well, it's like Sesame Street, right? You got three things. Which thing doesn't fit together? We got jet fuel over 200. You got diesel that nobody can source anywhere, and it hit a record high here in the country. And then I look over at WTI and we're trading 95. Those two things right? Everybody's conservatively projecting that we end up at a record low global storage for oil. That doesn't correspond with $95 crude, right? So what the market is hoping, in my opinion, is that, and it's the only way I can rationalize it, the market's hoping that this mispricing lasts until this is resolved and the worst is realized. And that appears to me at this moment to be an unbelievable optimistic threading of a needle that just seems insane. Yeah. So, I mean, like, I think anybody to make an argument that this is an accurate price, I would just say then you're saying everything else is wrong. You know what I mean? Like,
Right.
it's either diesel's either where it's at, jet fuel's where it's at, and the pricing on crude is not reflecting that, or it's the inverse. And when I look around, you got places all over the world that can't get jet fuel and diesel. So I go, I don't think those are mispriced. So I don't know.
Yeah. Listen, I am not, the technical analyst in oil. I leave that to Rory Johnson over at Commodity Context and our Oil Ground Up podcast. He's the guy. So obviously anything I say here is just going to be from my own pea-brain perspective. But we do have more numbers came out this week, not just on top of the inflationary PPI, hot PPI numbers. The market was kind of really anticipating the release from the EIA weekly inventory draw, and that also came out this week. This morning, we are recording this Wednesday afternoon. The expected draw on the week was 2.1 million barrels. The actual draw was 4.3. Third consecutive large weekly draw each week. Crude is trending towards its lowest levels of inventory since 2022. The EIA said the global inventory draw was 300,000 barrels per day. This week, that same agency revised it to 2.6 million barrels a day. I am surprised President Trump hasn't gone out and fired the EIA to try to make those numbers appear a little bit better.
Yeah, I mean, I think, and if you go total petroleum, the numbers are scarier than just looking at the crude. Like, I think you're close to 50 million barrels of total petroleum that have left the U.S. in the last just 3 weeks. Like, these are huge numbers. I mean, at that rate, the U.S. is down to line fill. Before the winter, like, you're down to, like, you have none. So. And so far, they've been really good about, being like, hey, we're not going to do any export controls. They floated it, and then they denied it, and then they re-denied it after they talked to oil execs. But now all of a sudden, I feel like you just do the math, and you're like, oh, no, like, you're going to have to limit exports. And then these other countries that, thankfully for them, like the U.S. is exporting, that China has slowed down imports, like that. Those two things help a lot. But both of those things are temporary. We're not going to keep exporting at this rate if the strait stays closed. And China's not going to keep their imports, this subdued, not to mention that they're sharing, products. So I feel like the first few weeks we worked through a buffer, and I was like, all right, well, I guess that makes sense. It's kept us down some. Now we're working through the charity of the U.S. and China that, again, that doesn't last that long. So, it won't be long before, like, as Paulo Macro said, like, you're going to hit the wall going 100 miles an hour instead of 20. Like, I think that explains it well. As long as the price isn't going to reflect physical reality, you just hit the wall going that much faster.
Mm-hmm. Yeah. Do you guys have a sense of where the physical reality actually kind of wrecks the energy scarcity, where it finally overwhelms this AI-driven equity narrative? Like, do we have a sense of how or when or why? No, it's just
no.
Just keep going. Just buy stocks.
Go ahead, Zach.
Well, there's something that we have talked a lot about, and I think that you would be wise. I mean, you can go back and research this yourself, or you can take our word for it. But this market has transformed, so it does not work like it used to. And the reason I can say that confidently is we've made a lot of money on that. Like going into COVID, and one of the we've brought this up on our show multiple times, but one of the craziest times in my career was the January of 2020, right? January when COVID was just starting to hit. And we were watching really carefully what was going on in China. We thought it was kind of critical when China effectively put 750 million of its own people on house arrest. And if you go back and remember that January, and that announcement from China came in like early to mid-January. By the end of January, the S&P was up 13% that month alone. It was just looking past this. And it was so obvious because you're sitting there going, all right, if China puts 750 million people on house arrest, that means that you just effectively shut the manufacturing floor of the global economy. Like that's going to be a problem, right? And so we were loading up on treasuries and long vol. And the only reason I didn't buy more was because it wasn't moving. You're sitting there going, we're shutting down the global economy and you're going to sell me VIX at 19? Okay, I'll take that, right? And then all of a sudden, it was like the world woke up and realized what was smacking them right in the face at 100 miles an hour. And then boom, I remember, the treasuries that I bought at 1.8% yield within like a week were yielding 0.38 or something like that. VIX, we were buying at sub 20. VIX ends up making a new record high over the next 5 weeks. And so we've had several of those where you're going, wait a second, this situation alone destroys the efficient market hypothesis, right? And so I think that for a host of reasons, record retail involvement via derivatives like options and futures, ETFs, passive flows, and then 16 years of a stock market, the biggest, longest bull market in U.S. history with record valuations realized. I just think all those things coalesce and make this market extraordinarily risk blind and risk dumb. And so I don't think you're gonna see what the reality in crude is in terms of actual pricing until tanks go. Like I am prepared to wait for it to take as long as tanks running dry and people saying we're out of oil. Yeah. This market has showed us that too many times, and it appears to us it's doing the same thing right now.
The math has a trajectory of basically July. That's what we're seeing. If we continue this inventory drawdown at this pace, July is kind of like on the map. Mm-hmm. Now, I may even push that forward, and maybe because normal people aren't going to be paying attention to the EIA inventory draws each week, and they're going to be paying more attention to the pump. On an inflation-adjusted and wage-adjusted basis, the energy crisis of 2011, where unleaded gas went to $4 a gallon, that was the breaking point. That adjusted for present day is now $6 a gallon. Mm-hmm. So I'm either waiting for, and I've been telling people, I'm either waiting for July, 4th of July fireworks, or $6 per gallon of gasoline, whatever comes first. And I think
be a great horse race between those two.
Right. But and that's just kind of how I'm seeing things. And I want to go back to maybe the similarities here, Zach, with how you were playing your hand in the market during those early days of COVID, where that was certainly demand destruction. Mm-hmm. Of volatility. What I think we're on the brink of potentially is a complete supply destruction without the demand kill. We're not seeing any demand kill whatsoever. So what cards are you playing with now? What is similar? What is different from 6 years ago?
Well, so right out of the gate, the demand destruction narrative is really interesting to me because there are people that know the oil industry better than I do that would tell you there is demand destruction going on. And that's undoubtedly true, but I think that we have to look at it from a slightly different context because you don't get demand destruction because crude's at 95. right? You just don't. So the demand destruction is coming from the distillates, right? The pricing. But a lot of that pricing is just reflecting the fact that you can't get the underlying distillate, right? So the minute when you have true demand destruction, it, like in oil markets, it always ends up coming back every time it has. At some point it won't, but it always comes back. But that demand destruction, right? It starts coming back as prices start creeping lower, and it takes a little while to come back online. This is like a light switch, right? So the minute that you've got oil out there that people can get, that demand is going to come right back online, right? So that's another part of this that we're looking at is saying, look, when you do actually get a real straight opening, I think it's entirely possible. It may even be likely. And Chase has said this too, and he can probably explain it better than I can. But I don't think it's unlikely. Like, it's not what I'm betting on, but I don't think it's unlikely to think that the record high oil prices might be reached after the strait is quote unquote opened. So
people can realize it doesn't just come back in a light switch. It takes a lot of time.
like, so for instance, like, okay, if you open the strait right now today, you've got to demine it. We don't know how long that takes. I would think it wouldn't take too long, but you don't know. And then that would also assume that Iran just said, oh, everybody resume as usual. That's not what they're going to do. But even if they did that, you're still looking out. You got to bring that production back online, right? You got 13 to 15 million barrels of production shut in. We've got unknown amounts of damage done at refineries around the Gulf Coast countries. And so that's going to take some while to sort out. So, but even if they opened 100% and you said, roll everything we got, you'd still be rolling. You'd still have a market in massive, right, deficit, right? So you'd still be drawing for a good 2 months after you fully opened. And then remember, once you open and you free those tankers are 5 to 7 weeks away from their end destination. So when you're talking about inventories getting as low as we're talking about, you're talking about the potential of seeing the bottom of tanks that nobody's seen since they were built, right? So, it's just wild to watch. I'm not saying that oil should be at 200 right now. What I am saying is it is wild to watch a market that is pricing in an absolute ideal and perfect landing in a situation that seems incredibly difficult to handicap, that is currently on a heading that leads to disaster, right? So I'm not saying that the market should be pricing in total disaster. I think the market should be pricing in the fact that we're approaching a red line, that the engine isn't, at least it's hotter than normal, right? And it's just not. And that's the crazy part to me. I understand different reasons why and different factors there, but that's just crazy. And I don't take it lightly when it scares me when I hear myself say things like the market's wrong. Right? It does. As an investor, that should scare the heck out of you. But sometimes it is. And when it is, and you're on the right side of it, there's a lot of money to be made. And that's the other thing, is that buying oil and all that kind of stuff here, I'm not telling people what to do, not a recommendation. Just regardless of where you look at it, if you're going to make an argument to me right now why oil and oil producers aren't pretty convex investments, it's going to be a really hard thing for me to buy from you, because they look extraordinary. If crude, I'll just say it out loud, right? Strait's been shut over 2 months now, and you can get WTI at $100.
Right.
If you'd have told me that 2 months ago, I would have laughed in your face. You just said that's not even possible.
Right. Chase, let's pivot to you, and I kind of want to start getting kind of a bigger glimpse and talking more on the commodities sector. We will dive into metals and miners for sure, because I know both of you have some thoughts on that. But before we kind of set into that trajectory, I'm just getting reports that Kevin Warsh has been confirmed as Federal Reserve Chair in the Senate vote. So I guess that's pretty much a done deal. But I did want to ask you about, now that we have inflation that seems to be more no longer demand driven, but more supply driven, does that create, how much of a dangerous setup does that create for Mr. Warsh and the central banks that this market currently maybe doesn't appreciate?
Yeah, it's an impossible situation. I mean, because normally you don't want to really hike into that. Uh, and I would say that if this was pre-COVID when we hadn't seen inflation for 30 years or whatever, like, then who cares? Like, let it burn itself out, right? But now you come into this, you've been above target for 6 years. You're still well above target. You cut rates while you were well above target. Inflation expectations are nowhere near the anchor that they had for my whole life until, lately. So letting this thing burn itself out now becomes very sketchy. And I think a lot of people look at this and they go, oh, yeah, but it's just supply. It's just oil. Like, you can't raise rates into that. The problem is, as PPI, in my opinion, shows, because if you strip out energy and PPI, it was still red hot. The problem is, like, this stuff gets into the price of everything. Like, services inflation is very warm right now. But if you think about it, like, everything a service, sector business buys is probably impacted by the fact that every plastic that they buy, which is in a lot of stuff, is more expensive. Every food item they buy is more expensive. Like
Rubber.
their energy is going to be like everything they buy is going to be more expensive. Yeah, rubber gloves if you're cutting hair, right? Or you're a doctor. Like this is hard to avoid. Not to mention the transport cost of getting it from where it was made to you went up a bunch. So the inflation is inside of essentially everything at this point. So that means you should probably hike, because if you don't, real rates are going to collapse and then you're going to get a giant speculative bubble. And I think we see a little bit of that. I think it's one of the reasons you're getting a lot of intense pricing and some of the tech sectors is, well, real rates just went down a bunch. And if you don't think the Fed will hike into this, they're just going to keep going. And then on top of that, obviously, we're going to get the automatic stabilizers if the economy has a problem, that will rip the budget deficit. If they waive the gas tax, there goes the budget deficit. So next thing you know, you're creating new money to cover the budget deficit, and M2 starts to rip higher. That's inflationary. So for all of those reasons, they probably got to hike, like, and probably a good bit. And you kind of mentioned it's not just the U.S. Like, everyone's going to have to do that.
They've already started. It's already started.
Right. Some places are going too slow. Like, you still have Mexico and Brazil. Like, let's just keep cutting. Now, the real rates are really high, so they can get away with it for a little bit, but not forever. Another point I'll make is we've had deflation coming out of China for a while now. Like, I mean, especially like factory gate, their PPI has been just crazy negative. So whenever you buy stuff from China, like, it just keeps getting cheaper. Well, now all of a sudden they have their own inflation problems because all their input costs are ripping. So now instead of importing deflation from them and everyone else you import from, no, you're going to import inflation from them. So we have all these like sources we took for granted. Energy was one of them, food was one of them, and then Chinese manufactured goods was one. All those things are now way more expensive looking forward. So it's a reason, like, the Fed's just now come to grips with, like, maybe we can't cut, and you're just now starting to see the talk about, like, we might have to raise rates. So I think, which is funny because Warsh was supposed to come in and save the day and slash rates to zero and into the productivity miracle, and like everything was going to be sunshine and rainbows. The reality is the committee might raise rates, like, right in his face. Probably not his first meeting, but like maybe his second or third meeting, though. Even if he doesn't like it, even if he's taking insane political pressure from the top, like, they're just gonna have to do it.
That is going to be the greatest soap opera. Like, there will be books written about the dynamic between the Trump administration, specifically President Trump and Kevin Warsh, and the setup that they're both battling for. I can only imagine in my head how that script plays out, but it's not pretty, and it will be entertaining. I will have popcorn and watching this whole thing.
It's gonna be juicy for sure.
The other funny part, or not funny, none of it's funny, it's serious, but it's one of the other kind of weird parts about this whole scenario is, ironically, Trump would have actually bought himself more time had oil prices gone higher, right? It would look bad. It would look worse as a PR, but listen to all the things he's talking about. He still wants rates lower. Okay, well, that means you're stimulating demand in a supply shock.
Mm-hmm.
That's insane. That's just insane. So the other thing is higher oil prices apply more geopolitical pressure. right? It does the work of rate cuts for you in a certain way. It lowers demand, so inventories last longer. This is just a mess. It just like it looks. This is like a Frankenstein policy that's just we've just glued it together as we've gone along without a lot of what feels like a lot of thoughtful consideration about how to properly handle this. And the other thing too, and I know I'm speaking to sympathetic people, but um, and look, you can't say you know for sure how anything's going to play out, and you can't fully discount anything. But that being said, um, I I don't think this ends without significantly higher oil prices, right? Like what eventually Iran is not going to capitulate. They're not in a position to capitulate. Um, this ends when Trump decides calls no joy and heads home. When is that? I don't know. I think that will be caused by substantially higher oil prices. So anyway, that's the weird part about this is that you're doing something that is literally threatening global recession and a humanitarian crisis while simultaneously muting out any type of immune response or market response that would happen on its own to make the crisis less acute. And so, like I said, is it possible you still thread the needle and land this thing? Yeah, but that possibility is getting smaller and smaller by the day because you're not doing any of the right things to increase those chances. So it's just wild to watch the policy response on a day-to-day basis when, in my opinion, you're watching us get closer and closer to this global disaster and potential humanitarian crisis, and we're doing it all with nothing to win. Right? Like, what's a win in Iran?
We will lose more. We will lose
right.
more.
Right.
We already have. I mean, I'm glad you brought that up, Zach. And sorry to interrupt you, but
you're good.
Like, I want to kind of talk to Chase about this because I had the same conversation literally this morning. Somebody asked, well, why? I mean, why wouldn't Trump? You think Trump would just pull away? And I made it go back to Chase. You and I had a really good conversation in Nashville earlier this spring when all that military infrastructure was being mobilized into the region. And I remember asking you, like, it seems like a lot. And Chase, you said, yeah, you wouldn't move that much if you weren't real serious. And so here we are. And it seems like an aborted mission or just departure is significantly decreases the United States overall pull and power in the global framework. We've had the argument that has continued to dwindle no matter what, but this would certainly be a huge cut to that framework. You also hand over power of the Hormuz Strait to Iran, who once only controlled 4% of global oil, but because of that move, Iran would arguably control 20% of global oil flows. Nothing good comes out of this, and it almost appears that escalation into something much more powerful, much more military, is probably the only solution they have to get out of there scot-free, but that also comes at an enormous cost. There's a no good situation here.
Yeah, I think you take a really bad loss here, or you take a catastrophic one in a few months. Like I posted this earlier, but like you had the Bismarck quote: "The politics is the art of the possible," and then you have the Clausewitz quote of "War is politics by other means." So like, what that eventually comes out as is we have to start from what is possible whenever we view this. Like this can't be a Disney movie. Like this has to be what the reality is. And the reality is if you don't want to, have a draft and send hundreds of thousands of people to a brutal kill zone, because that's what that country is, the topography, then you're going to have to take a very, unfun, loss here. Like it's going like just leaves them in a really good spot compared to where we started here. Any deal they're willing to take is going to leave them in a much better position than they were. And you see that in negotiations. Like they haven't even moved an inch from their maximal demands,
Right.
nor should they, given the reality on the ground. And neither have we. Like we're still like we're basically offering them the like Treaty of Versailles as like, you will submit and you will surrender and you will agree that you cannot defend yourself anymore. They're not going to do that. So, and I don't know if if we don't realize that they're in a great spot, or we just can't accept that they're in a great spot. I don't know that part, but the bottom line is they are. And unless we're willing to pay a cost that is completely indefensible for what there is to gain, we're just going to take a bad deal. And maybe you're trying to get to a political situation where people accept that. Like maybe if oil is 200, like people are like, well, it sucks that we lost, a lot of strategic, sway here, but yeah, $200 oil is way more, annoying. So let's just get out of there. It may just be that simple. I don't know.
And
Can I
here's the
oh,
kicker. Here's the kicker, right? The overarching theme is, well, we need to do all of this so they don't get a nuke. Well, you just gave them a nuke, and you gave them a nuke that pays a $400 to $500 million daily dividend, right? Like, wait, if you offered me the current setup in the Strait or a nuke, I'd take the setup in the Strait. Right? I
Yeah.
mean, you have the global economy at its knees. Now, eventually they'll start rerouting supply, and they're not going to let you hold on to that forever. But I mean, like I said, why is it better than a nuke? A nuke doesn't pay you $400 or $500 million a day, right? Like those are the tolls they'll be collecting from the Strait. So we got to keep them getting a nuke. I think you just gave them one.
Yeah. Chase, I do want to ask you, and hopefully I'm not trying to dive too deep, but there was two things that really in the news with the US military since this whole thing started that really kind of made me pause and deeply think, just because I'm a father of a young man. That was the increasing the draft age.
Yeah.
And then that hit pretty heavy. And then the other one was really the routine firing of heads of the military. And I'd have to go back and look to who they were, but they were by far really up there in military and this connection with the administration. But I think 3 individuals, high-ranking individuals, were fired. And it just I think that the raising the age of the draft obviously has its own effect, because I'm like looking at my son and I'm like, I'm fearful. I don't want to
For sure.
send our young men to war.
Mhm.
Or the other part of the story, the firing of those military professionals, it was like, who are we listening to? Who are we really listening to? And why do we have such a mistrust with so many institutions now that it's already infiltrated the US military, which is the most powerful military this world has ever seen? And now we have mistrust there.
Yeah, this is something that deeply disturbs me because just in general in government, I think professionalism is incredibly important. Like, and very nonpartisan, doesn't care about politics, professionalism from not just the military, but civil servants. Um, and you see it in the polling. Like one of the institutions in America that continues to actually poll well is the military, and I think I would say we, but I've been out for 3 years. They have deserved that, have earned that, because they execute at a high level and they do so with a lot of professionalism and integrity. And so to see some of that is concerning, because it does feel like politics have entered an arena that they don't belong in. Um, I hope that's not the case. Maybe it's just some personality nonsense or something, but even that doesn't belong. Um, but you made the point of like, who are we listening to? And that's one of the areas of frustration for me, because if you go back, well, now you can see it, but if you go back, the intelligence community is assessments and the obvious advice that General Kane offered the White House were all like, oh, this is a bad idea. Like, Iran has more capabilities than, we have seen them use, and you should be careful with that. They can and will, if they need to, close the Strait of Hormuz. And the assessment was like, yeah, you're probably not going to knock over the regime with an air campaign, because, well, that's never happened before, so there's no reason to bank on it happening now. So it's frustrating to see the fact that like, hey, like the intelligence community and the military basically stood up and said, oh yeah, I wouldn't do that. And here's all the reasons that it's really risky. And we just did it anyway. And even now, like you saw yesterday, the like, saying Iran's doing well here, is like treasonous, or borderline treasonous or whatever. And at the same time, you have the intelligence community saying like, well, it looks like they have at least 70% of their missile launchers and their missiles left. And it's like, okay, well, the intelligence community is telling me that they're actually doing pretty good here. We don't have 70% of our interceptors left, not even close, So like, to your point, yeah, it's frustrating. I feel like there are areas where only very, very serious people belong, and obviously the Pentagon is one of those places. So to see the possibility that some of the professionalism has been eroded, it is deeply concerning.
Hey, stay right there. We'll be right back after a very short break.
In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Terra Hutton is a Sweden-based mining investor platform built to make the invisible investable. Even the strongest project can be overlooked. Geology is inherently complex and data-heavy, and when it's reduced to raw numbers like drill results and technical reports, investors can miss the story, and companies can miss out on investments. Terra Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early-stage exploration or more advanced development assets, Terra Hutton helps turn complexity into clarity and information into insight. The kind of transparency that builds loyalty over time. Visit terrahutton.io to learn more.
Hi, I'm Rory Johnston, host of the Oil Ground Up podcast. I'm also the founder of Commodity Context and have been an oil market analyst for more than a decade. What I love about the oil industry is that it is both unquestionably essential to our modern life, and the supply, demand, and pricing of this indispensable product is driven by an ever-changing cornucopia of geological, geopolitical, and technological developments. Listen as I speak with experts across the industry to explore everything you've always wanted to know about what's moving the market for black gold. Find the Oil Ground Up podcast on Apple Podcasts, Spotify, and at clearcommodity.net. Brought to you by the Clear Commodity Network, digital news on the physical markets.
All right, boys. We're going to do a hard pivot here. I don't know how much. I mean, we could really go down a long rabbit hole here, but I do want to try to get this back and talk on the commodities cycle, natural resources. And obviously, oil is driving this huge, big big driver here. But we're seeing wheat, copper, silver breakout. You guys have both talked about the idea of that commodities are reasserting themselves once again in financial assets. I just saw a clip from CNBC where a woman who was a guest said she's not interested in gold in her portfolio because it doesn't yield anything. So still early days. Still early days. Like, what do you see? How do you feel about this? I don't think people are seeing this breakout yet in the general physical commodities of things, but it won't be long until they do. Zach, maybe let's go back to you and talk. I'd asked you about a playbook here. Are you still feel like we're pretty early in this commodity cycle?
Yeah, I do. And the reason I do, I think there's a lot of really good data points to point to that have occurred recently, but I think also looking at the recent past is, past is often a prologue. And what you've seen this incredible stock market run that most of it occurred with virtually, the slowest wage growth and slowest employment growth coming out of the financial crisis on record. And so you just had this kind of like central bank dominated, monetary policy dominated, low growth, low inflation environment for so long. And, nobody needs to tell you this, but any of us that have been in metals and commodities before, in an environment where low inflation is the problem and low growth is the problem, there's virtually no investment in the underlying commodities. Well, you get 10, 12 years down that path, things change, right? You look at the things that have occurred in green energy, it's created whole new demand cycles for these things. And then you go back and look at how much the supply is kept online. Go look at new mine openings over the last 10 years. And that tells the story, right? So you've opened up new demand channels and you don't have the stuff. So it's not going to go in a straight line, right? It never does. But I think that and a dollar that looks like it's broken a long-term uptrend. And furthermore, to get into it, and as always, I reserve the right to be wrong because I am, so it's, as much as anybody. But our view on this is that this event, especially as it relates to gold miners, I think it's going to create phenomenal buying opportunities. And the reason I think it's going to create phenomenal buying opportunities is, as incredible as it seems, I think the investment public writ large is still unfamiliar or not aware of what the underlying financial situations in so many of these miners are. I guarantee you the average retail investor out there does not know that you've got big mining companies throwing off 55, 60% operating margins, right? And so when you look at oil, will higher oil help that? No, but you don't have the current financials priced into these things. So if I'm right, I think this oil situation is going to hit these things harder than it should. You've already seen it do that, in my opinion. And I think it's going to create great buying opportunities. But yeah, I mean, you look at the types of inputs that are needed, for these new technologies that are coming out, the data center spend hugely, a voracious appetite for so much of these metals. Then you flip over, look at central banks, right? Central banks are concerned about hedging dollar risk for the first time in 40 years. So you only do that with one thing, right? Via gold. So, yeah, I just, like I said, I just look at it, and that sector to me looks like all systems go. Do I think that 3 years from now, central banks are going to have less of a need to hedge their dollar risk? No. I don't think that the U.S. fiscal situation is going to get any better. And so, yeah. And like I said, people, we throw this out there all the time, but people just don't get it. We're not talking about oil. You can't just stick a pipe down in the ground and start pumping it out. You find a resource and you're 10 to 12 years, best case scenario, from pulling something out of that thing. So, they'll find supply. They'll be, as prices climb, they'll have better recycling methods and they'll get supply from other places. I'm not sitting here saying I think you're, hold out for $20,000 gold and $1,000 silver. But yeah, I mean, when you look at and you compare it to past cycles, you look at how long the bear market lasted. I mean, you basically had metals in a bear market from 2011 until COVID. I mean, yeah, I think long-term, I think it looks great. And I think you look at opportunities like this where, and here's why I love this opportunity, Trevor, and I know you know this, but I love it when real things like higher oil hurting gold companies' earnings drives gold companies down, because the people that are selling it usually aren't familiar with what those earnings actually are. You know what I mean? And so I can sit there and go, okay, so you're telling me you think $100 crude makes that gold miner worth 30% less? No, it doesn't. You're wrong. I'll take more of that. Right. So I'm hoping that when we get this, like if I could plan it out perfectly, I'd be selling crude at 140 and turning around and buying gold stocks that were down 40.
Yeah. I mean, you're right. The generalist public continues to avoid not only miners and metals, but natural resource stocks in general. And we know that the concentration of equities that continue to help support a move higher in the equity market is down to single digits. You can call it the Mag 7, maybe even Mag 5 now if you wanted to. But we're just also watching some of the biggest tech CEOs travel to China alongside Trump, while a handful of mega cap AI names continue to dominate, the index performance. This trip alone with these tech CEOs, what does that symbolize? I mean, to me, it symbolizes just how concentrated and important these companies are to keep the market elevated, because it's such a high percentage of this country's GDP. We are hyper-financialized. We depend on 5 people making trillion-dollar companies. Like, That is insane.
That's a bad strategy. So real quick, I want to interject on like commodities broadly here because
Sure.
so since the war began, the S&P is up like 8%, which is impressive given the backdrop. But gasoline is up 75%, gas oil is up 55, cocoa is up 54, oil itself 51, diesel 48, cotton 36, rice 19, aluminum 16, wheat 13, copper 10, orange juice 8, canola 8, soybean meal 8. So like there's so many like commodities that are doing more, and like how many people know cocoa's up 54% since then, right? If like cotton ripping, like cotton's in a lot of stuff, and a lot of people were pivoting to cotton from, you know, the oil-based, petroleum-based manufacturing for clothes. Well, then cotton rips, and like in that way there's kind of no place to hide. Like corn and wheat are in basically every food on the planet, like as well, at least in America, where we, you know, we have super processed food, I guess, maybe. But so to go back to that inflation point, like and obviously like and that's now. So the next crop, which obviously is going to have less or more expensive or both fertilizer, can get more dubious. We have a pretty hardcore looking El Nino. That's the reason some of these crops are doing what they're doing. Like, yeah, like sure, like the S&P is doing pretty good. And I guess if you just want to, you know, chase the new DRAM ETF up 100% and then back down to who knows where, like sure. But like, I don't know. Like when I look over and I see cotton and cocoa up 50%, like and I'm like, cool, congrats on your 8% in the S&P. And to your point, that requires these dudes, you know, flying around the world to cut deals and, like you say, make $1 trillion companies. Like, I don't know. Just, there's a lot more to do out there.
Yeah, agriculture does feel like it's the next shoe to drop. I'm with you.
Yeah, if you just chart them all, you just see breakouts left and right.
Yeah.
Which is not great.
No, and none of it's good. But like that's what we were saying earlier when I said, you know, higher inflation, higher costs, a fait accompli. I mean, just book it. And the fact that people aren't expecting that right now just really, really blows my mind. And then, like Chase said, you look at what weather's anticipated, El Nino year, and that, and these are the things that, like, look, I hope we're all wrong and somehow they land this thing safely and all that kind of stuff. The things that make me concerned right now, though, Trevor, is that, you know, when you study like horrific outcomes in the past, when you study economic disasters, humanitarian crisis, stuff like that, it's usually never the thing, right, that causes the issue. It's multiple bad responses in a row to the thing, right? And it's like what we've talked about on our show is that in airline pilots refer to it as the chain of errors, right? Where it's like in airlines, a buddy of mine was a pilot and he was explaining this to me and he goes, when you look at airline crashes, it is almost never about the failure, a mechanical failure. He goes, it is almost always an issue that gets responded to incorrectly, which precipitates another incorrect response. And so you get this chain of errors that leads to a crash, right? I fear, well, I don't fear. I know that right now we are on that heading here. And I want to pivot back away from commodities here to talk about Iran, but we're on that heading. What do I mean by that? If you hold the current course that we are on for the next 2 months, you're probably looking at a humanitarian crisis and global economic recession. Just full tilt, right? So we don't need to change. We don't need to pivot. We don't need to have something else bad to happen to bring out about worst case scenarios. We just need to hold the current heading. And when you look at the political machinations back and forth that make that difficult, like it's going to require Trump to swallow a deal that's worse than anything Obama signed, that's worse than the JCPOA, that puts Iran in the best position they've been strategically since the revolution 47 years ago. I don't think it's hard to imagine that this gets way worse before it gets better because there's just no good choices, right? There's no easy outs. There's no easy off-ramps. And so when you look back at the commodity complex, like all of it across the board, these things are actually needed. And then I look over the other part of it too, is I go, I see tremendous convex opportunities there all across the complex. where the underlying valuations look extraordinarily attractive and fundamentals. Then I flip over and look at tech right now. I am not telling you to short tech. I'm not telling you to sell it. I'm not telling you to buy it. I look at semiconductor. It's just a no-go for us. Right? Like I don't even know what I'm buying. Meaning you're right. You're paying. Look, they could all end up being right, and I could be wrong, and that's totally possible. But again, I feel like you're trying to hit a 115-mile-an-hour fastball when you could opt for a 60-mile-an-hour one, and you're just making it way too hard on yourself. Like, when I'm buying a chip company that's gone up 5x in the last month, and now every day is going up multiples of its annual revenue, I can't tell you you're paying too much and that that's going to be a bad investment. I just don't know what price would be good. I don't know, right?
Right.
And then I look over in the commodity complex, and I feel like I'm looking at a lot of 2, 3, 4 bag type investments over the next 2 to 3 years, and it just looks a lot easier.
Do you feel like the commodity equities remain mispriced?
Oh, yeah.
In general.
Yeah. And this happens in every cycle, right? You hear everybody sit there and go, yeah, well, they're always going to be underpriced because they're bad businesses. And I'm like, yes, so says everybody about every sector that is in a trough, right? They're not bad businesses right now.
No.
Right? Like Warren Buffett says, right? The number one defining characteristic of your investment is the price you pay. Well, go look at the prices you pay and what kind of returns you're looking at as a shareholder right now, and go make a case for me to why you think that's going to be a worse investment over the next 5 years than buying chip names trading at 25 times annual revenue. Again, I don't have a crystal ball. You may end up being right. I just know if we roll that bet enough times, I'm going to come out winning a disproportionate number of those bets compared to you. And in the meantime, it's also, like I said, a lot easier, right? You have a shortfall. You don't have enough of this stuff. Every day, governments make it more expensive to extract the stuff. The stuff's probably going up a lot.
Right. All right. Zach, we're going to leave it at that. Somehow we've lost Chase. He fell off
he
the face of it.
disappeared,
He
man.
I think he had enough.
No,
we weren't even
some
arguing.
technical issues. he had a technical issue. I guarantee it.
Yeah, not a problem. Hey, I appreciate the time you guys gave us for this long conversation. Tell us about Bulwark, where they can find, obviously, the firm, and then also the podcast that you guys continue to put out. Great conversations just like this one.
Yeah, thanks a lot, man. Yeah, so we are an RIA. We manage about $1.1 billion and located in Tacoma, Washington. Like you said, Chase is the head of research. I'm the founder and principal of the firm, chief investment officer. So you can find us at bulwarkcapitalmanagement.com. We manage high net worth people. We manage all across the board, so retail clients. We also do our daily show, kind of a market wrap called the Daily Dots. Gives you a summary of everything that's gone on economically and financially in the world, and you can find that at Know Your Risk Podcast. So yeah, Know Your Risk Podcast, Bulwark Capital Management, not too hard to find.
All right, Zach. Good to see you, man. Everybody
Hey,
good?
you too,
How's
buddy.
Family's good? All that?
Yeah, family's great. I was just went to a AAA ball game yesterday with my son's class for a field trip because they got to sing the national anthem. So
cool.
yeah, we're having a great time in the middle of Little League season. So we're blowing and going, man.
All right. Well, Chase, you did get back to say au revoir.
The interwebs came back to life.
Yes.
I just want to say thank you. And Chase, while we have you, you still doing stuff with the pine cone macro?
Indeed. People can reach out they want samples of that or something. Pinecomacro.com is where they can find everything for that.
Yep. Very good. Okay, gentlemen, forever grateful for your time, your friendship, and your insights. Thanks so much. We'll talk to you again soon.
Thanks a lot, Trevor.
Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.